Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Asset bubbles are an occasional, inevitable, and sometimes devastating feature of financial markets, making and breaking fortunes along the way. But what's the greatest bubble of all time?
We run the rule over 5 famous market frenzies. And in today's dumb question of the week, are markets rational? All right, let's get into it. So when you talk about markets, it's hard not to talk about bubbles. They're the thing that the media focuses on. The ramp up in prices, the devastating crash, the people jumping out of windows, whatever it might be. So I thought what we could do this week is go through 5 of the most famous bubbles. And maybe what we can do, Roman, is give them a score, like a bubble score out of 10, and we'll determine the greatest and most impactful financial bubble of all time. What do you think?
Sounds great. And what are the criteria? Size of run-up, maybe?
Yeah, that's a good one. So what did prices start at and where did they peak? Maybe also just the size of the market, like what was the market cap?
And also how long it took to recover.
Yeah, how big was the crash and how long was the market down? And maybe the fourth and final criteria we could have is, what were the wider impacts? Was this contained to just a few banks or whatever, or did it ruin the entire country?
Okay, I think those are good criteria.
Right, let's start with maybe the most famous bubble, or at least the one that gets referenced whenever the media talks about a bubble, is the Dutch tulip bubble, or tulip mania from the 1630s. This has somehow, in the popular consciousness, come to define what we even mean by an asset bubble, where supposedly the Dutch, those crazy people, bid up the price of tulip bulbs, like unhatched flowers. Hatched? I don't know. You're the gardener. Do flowers hatch? What do they do?
If you like, Michael. Yeah.
Yeah, they bid those up to crazy prices. So much that, people would be paying a year's salary or remortgaging their house or whatever to buy an unhatched tulip bulb.
But can I just say, before we start on the tulip bubble, that I don't like tulips. I think they're quite lousy flowers and they don't last long.
This is why you swerve bubbles, Roman. You're skeptical about everything.
But if you're going to have a mania about a plant, I certainly wouldn't go for tulips. For me, it's sedums. There'd be a sedum bubble if there was any justice in this world. So if we look at what happened during this craze, as it's called, the price of a bulb, so this is your unhatched tulip, as you'd call it, Michael, would run as high as 5,500 guilders. And that would buy you a nice canal house in Amsterdam, which, if you look at it today, would be a lot of money.
So these are expensive bulbs. What I found interesting when I looked into this is that people weren't actually buying the bulbs. It was traded using forward contracts, which was really interesting and one of the first examples of a forward contract. So how did this actually work? What were people trading here?
So the way this would work would be that you and I would enter into a trade today where I'd say the price that I'll be willing to pay for this tulip at some point in the future when it hatches, because you can't really tell how good the tulip is until it's grown and you see the flower. I'll agree to a price for that today. And then when the time actually comes for the thing to flower, then we'd have physical delivery of the tulip and the money would change hands.
Now, these forward contracts were very primitive, as I understand at the time, because look at this, Roman. They didn't pay any initial margin or a mark-to-market margin on these flowers. And there was no exchange standing in the middle. The counterparty risk was off the scale. It was just between two people.
But I suppose as long as the money hasn't changed hands at that point, it isn't a problem.
Well, it is if you're the one growing the tulip.
Yep, I suppose so. If you're going to bank on that huge payoff in future. But imagine what would happen if the thing didn't grow, or if a caterpillar ate it overnight. You'd be economically ruined.
Or if people just realised this is a crazy price to be paying for tulips, the market crashes mid-harvest season, as happened, and then you're left with these pretty worthless bulbs. But apparently what happened at that point, where, people had bet on these contracts, the market crashed, the bulbs were worthless. The people who were now due to pay a ridiculous price for delivery of these bulbs said, you know what, I'm not going to pay. I'm not going to give you any money, as you'd expect. So it all went to court, various courts across the Netherlands. And what the courts seemed to do is turn these forward contracts into options contracts retrospectively. Financial engineering. And they said you could sort of pay a fee, I think it was like 3.5% of the contract value to get out of it and not take delivery. So they made it an optional agreement retrospectively.
I wonder if the option price was based on the volatility of tulip prices, because that would be a really nice example of implied vol.
I think we're looking into this tulip bubble more than anyone has ever looked into it right now. Usually it's just a sort of funny anecdote at the start of a book or an article about Bitcoin or whatever.
But look, in terms of our criteria, this one has got to be a bit of a damp squib because, firstly, I don't think there was a wider economic impact because if you look at the state of Holland at the time, they were suffering from the plague. So there were bigger problems in society. So I don't think it had a wider economic impact. There was just a small group of people trading this stuff.
So what was interesting about this bubble is that the legend about how big it was kind of built way after the fact in a book by Charles Mackay called Extraordinary Popular Delusions and the Madness of Crowds. And this is where the legend came of, people remortgaging their houses and spending their entire annual salary on tulips. And it was just a craze which ordinary people were getting involved with, throwing themselves in the canal in despair at the crash and all that stuff. Really, modern historians have looked at this and said, you know what, that didn't really happen. It was more of a sort of drinking game played in taverns in Amsterdam where people would speculate with small amounts of money. Yes, there was a big run-up based on speculation, but it was mostly by really rich people who could afford to lose a lot. And like you say, the economic consequences were effectively zero.
I think it was actually promoted by the Dutch Tulip Marketing Association.
Not a very good promotion then, if they got associated forever with extreme prices. But it's interesting that this book by Charles Mackay, which is extremely influential and quoted in numerous financial and economic books over the centuries, was largely based on a satirical play at the time of the tulip bubble, which was making crazy claims. Like it was trying to be a comedy, like how big this tulip bubble is. And then it became fact, which is a bit strange, isn't it?
So overall, I think the rating for this one wouldn't be big. It didn't have a huge impact beyond the tulip market. It wasn't very long-lived. It certainly had a big run-up in prices, but I don't think there's a reliable source of pricing data. I don't think it's in Bloomberg.
The tulip market cap remained small, I think, throughout this, even if individual tulip bulb prices went crazy. There's a quote I liked from the economic historian Peter Garber, who said that the trade in bulbs was no more than a meaningless winter drinking game played by a plague-ridden population that made use of the vibrant tulip market. Gambling, I think.
So what do you think? 1 or 2 on the scale?
I'm going to go with 2 just because it became so notorious and is so well known that it's defined really what we think of as a bubble. So the legend gives it a little bit of credence, I think. What do you reckon?
I'd say a 1. I just don't think it was that important.
No bubble at all.
And it's not a kind of proper market anyway.
Okay, well, let's see if we can find a real bubble. Let's move on to the second. And we're going to go through these in chronological order. So we go to the South Sea Bubble of 1720. Now, the South Sea Company was founded in 1711 by an Act of Parliament in Britain. It was a public and private partnership that was designed to consolidate, control, and reduce the national debt and to help Britain increase trade and profits in the Americas, particularly South America. The interesting thing was that the company was granted a monopoly on trade in South America, and in return for that, it agreed to take on Britain's national debt, or at least most of it, which was around £9.5 million at the time.
So this had all the makings of a big bubble. It had government support. There was lots of awareness of the overall market and the impact of that support. So people piled into it and built up a massive narrative around the bubble.
So the idea was that this trade with South America was going to be so lucrative, it was going to more than pay off the national debt and leave investors with a massive profit. They were originally promising something like 6% as a dividend, and I think it got up to something like 100% dividend at one point. And King George himself took governorship of the company in 1718. As you can imagine, the king stepping in to take charge of the company boosted the stock somewhat.
So this is a bubble by royal approval.
Indeed.
And guess what happened? Yes, the bubble burst. And after reaching incredible share prices, so the share price by August 1720 hit over £1,000. And that was from an initial price of around 350. Inevitably, the whole thing imploded.
Yeah, it was interesting how the bubble got inflated. Once the trade didn't materialize, the company was basically issuing new stock, selling new stock all the time to raise capital to pay the interest on this debt it had taken on, which is basically a Ponzi scheme, right? It was just bringing investors on board to keep itself afloat.
Yep, that's Ponzi finance.
Which works well up to a point. And it wasn't just this one company. What was interesting was that around this South Sea company, which was, kind of being run with royal approval, there were lots of other companies, joint stock companies, which were claiming to do the same thing. And they became known as bubble companies. And again, that book from Charles Mackay describes some of these companies. One invented a wheel for perpetual motion and raised £1 million. Roman, both as a physicist and as an investor, that must set alarm bells ringing. Another was encouraging the breeding of specialized horses, aiming to make them run twice as fast. Yeah, maybe. And maybe the weirdest one, actually, which Mackay describes as absurd and preposterous, described itself in its listing documents as a company for carrying on an undertaking of great advantage, but nobody is to know what it is. Trust us, bro.
Hey, that's called a SPAC nowadays, isn't it?
Yeah, it is, Roman. And they actually sold out their listing. And then the entrepreneur promptly disappeared to continental Europe. This seems like a bubble, doesn't it? IPOs going crazy.
And this didn't just affect a few crazy investors. This really pulled in some big names from the time. For example, Isaac Newton did pretty well initially. So he bought at a fairly low price, he sold and then made a massive profit. But then he got this really bad FOMO and then he bought again right at the top and ended up losing the equivalent of £40 million in today's money.
Yeah, a lot of people were burnt and a lot of prominent people in London, which is probably why it became such a scandal. If the poor plebs lose money, no one really cares. But when Isaac Newton's losing tens of millions of pounds, stuff's going to happen. There was a parliamentary inquiry into the causes of the crash. They uncovered evidence of, yep, you guessed it, insider trading, bribery, all the good stuff. And company directors were actually punished, including cabinet members. They were convicted. They went to jail. Didn't see any of that after our bubbles, did we?
Not really. I think people got off scot-free after the financial crisis.
Yeah, and the government actually seized most of the shares, allocated them to the East India Company, no bribery involved there, and to the Bank of England. And perhaps most strikingly, the Chancellor of the Exchequer at the time, John Ailerby, and he'd been given £20,000 of company stock in exchange for his political support. He was removed from power and imprisoned in the Tower of London. Consequences, real consequences here, Roman.
Tower of London, that's what we should do for these financial crises. Bring it back.
What do you reckon? Liz Truss, Tower of London?
Oh, at least. But this also started the tradition of creating new laws to stop the previous crisis. And in this case, it was the Bubble Act of 1720, which forbade the formation of any other joint stock companies unless it was approved by royal charter.
Some people said this was actually the South Sea Company trying to maintain its monopoly as all these other bubble companies were formed. But yeah, I think it was really the government trying to put a stop to this mania. In terms of the wider financial effects of this, there really weren't too many. Like apparently Georgian society went on without any real negative effects. And even the South Sea Company itself did continue to operate until the mid-1800s. So I don't know, where are we going to score this on our bubble meter? It seems like a bigger deal than the sort of fake tulip bubble.
Yeah, but I guess this was not a thing which would affect the wider economy. So in those terms, I don't think it scores particularly highly. So let's call it a 4 on the scale from me.
Yeah, I think you're probably about right. I mean, it did invent the word bubble. That comes from the Bubble Act. So again, it's a notorious episode. Yeah, I'll go along with you. 4, I think, is about right. Shall we move on to the 1920s? Let's fast forward. So this is called the Roaring Twenties, which obviously culminated in an enormous stock market crash and the Great Depression in America and much of the developed world.
And I know certainly this one was huge in terms of impact, not just for the US, but for the global economy. So I think this one definitely scores high on the economic scale.
Yeah, the Depression cratered living standards in America at the same time as global trade was contracting. And this all sort of set the scene for World War II, really. It was all part of the same narrative.
Certainly people say that the fallout of this was effectively greater geopolitical instability. But the thing that everyone focuses on is that one huge fall in stock markets in 1929. Black Monday is what people call it, on October the 28th, where the Dow Jones fell by about 13% in a day.
And what came the very next day? Black Tuesday. Not very inventive with the names, but the market dropped another 12%. So 13%, then 12% in 2 days. That's a big fall. But it came after a huge run-up, didn't it?
This is it. And I think people forget the fact that only if you bought right at the top would the impact have been really catastrophic. People always say, oh, it would have been atrocious. But of course, most people would have been investing for years beforehand.
But it was atrocious because people had bought on leverage, which we'll come on to. But let's take a look at that run-up because it was huge. So the Dow Jones increased sixfold from August 1921 to September 1929. So what's that? Like 8 years? And it's gone up sixfold.
So that ticks another box in terms of huge run-up.
And also shows the first emergence of those things which help us identify bubbles, where the media starts saying that, valuations don't matter. This time it's different. So the economist Irving Fisher proclaimed that stock prices have reached what looks like a permanently higher plateau.
And of course, another indicator, the famous one, which is the shoeshine boy. So there's this apocryphal story about Kennedy. And of course, this is Joseph Patrick Kennedy Sr., and he was the father of President John F. Kennedy.
A very wealthy man at the time. Did he get burnt in the bubble? No. Why not?
Because he heard stock tips from a shoeshine boy. And he took that as a contrarian indicator, because if the shoeshine boy is giving you stock tips, you know there's a huge bubble.
I don't believe this story. But, yeah.
Nowadays, I guess it would be something like the Uber cab driver, or maybe your hairdresser, or your favourite TikToker. I don't.
So he dodged the massive fall, and it was a massive fall. Following Black Monday, Black Tuesday, over the next couple of months, the Dow lost almost half its value. The slide continued the next year, and in the end, stocks wound up 89% below their peak. And in terms of our bubble thing about how long did it last, at least in nominal terms, the Dow did not reach its pre-crash level until November 1954. That's a long time to wait, even for the most patient buy and hold investors.
So there's another tick on our list.
Interestingly, though, because the Depression was very deflationary in real terms, like we always think about real terms and adjusting for inflation as elongating these kind of things, but this actually shortened it. Like the recovery time, if you adjust for falling prices, was more like 7 years, something like that.
But I think the economic pain is something that was felt so deeply by so many people, because I spoke to people in the US when I lived there who'd lived through it, and they were still talking about people being hungry. And for the US today, that would be a level of poverty which is just unthinkable.
So that's the Great Depression, isn't it? Now, obviously, this stock market crash is one of the causes behind the Great Depression, but I don't think we could say it was the main one. It was more that the fact that the banks failed over the next few years, partly triggered by this and having to take on a load of bad debt. As we said, people had bought on leverage, but also I think missteps from the Federal Reserve banks.
And it's worthwhile saying, just to go back to Kennedy briefly, what he bought was investment grade property and effectively made himself a billionaire in today's terms, and created trust funds for all his kids and basically made them financially independent for the rest of their lives. So I think this one is probably, certainly if you look at a graph of stock market falls, the one which really stands out. It makes the dot-com bubble and the global financial crisis look like a very small blip. So I think this one, certainly in terms of market impact, is probably the most meaningful one ever. Certainly for the US.
It's the one that scares you when you have to do backtests. If you've got data going back, over the last century, you think if that happened and stocks are down 90%, I don't know if I can hold on, right? That's the thing. It ruins your models. But why did it happen? Like, why was there this huge run up beyond all the fundamentals?
Again, I think this is about narrative. People just assume that stocks were a sure deal. If you buy them and they're going up, they'll carry on going up, which of course is true up to a point.
The context around the time, the Roaring Twenties, was a boom era, wasn't it? And loads of optimism. Families, like middle-class families, were becoming wealthy really for the first time in history. You had the new technology, you had telephone lines, cars.
Refrigerators.
Yeah, it was really a sort of step up and the journey of the Industrial Revolution into the home. And as the story goes, ordinary people started using this newfound wealth to invest and gamble on the stock market and taking on huge amounts of leverage. But if you look at it, according to Morgan Housel, who I know we both respect, he says that actually only 2.5% of the US population owned stocks at the time of the crash.
So maybe it wasn't so impactful, certainly not the market crash, but I think the economic impact is the one that really did affect everyone. And the unemployment rate surging to crazy levels above 20%. And that affected almost everyone in society. And then the economic policies that came after it, which was protectionism, which led to a collapse in trade, all of that compounded the problems. And at the time, the Federal Reserve wasn't really up to speed in terms of dealing with crises. So all of these combined, bad monetary policy, bad fiscal policy, effectively worsened the problem.
So what are we going to score this one as then? It's a good deal greater than tulips, isn't it?
Oh yeah, I mean, this one is very high because it's financial, it's economic, it's widespread, it's international. So I'd say this one would be about a 7.
Yeah, I think maybe even higher, like 8, 7 or 8, I think. It's long lasting as well and changed the course of the world. But it's difficult to untangle the effects because a lot of what we're talking about is the Great Depression and you can't pin all that on the stock market crash. Anyway, let's go with a 7.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. If you trade US stocks, then 24/5 trading gives you non-stop market access from Monday until Friday via more trading sessions, while still using Trading 212's fractional shares and zero commission trading. You can also switch between 24/5 and regular hours orders at any time. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. Terms and fees apply.
And now let's jump forward another 50 years to the 1980s and Japan. This is a notorious bubble. Now, one of the reasons this is so big is because it's not just a stock market bubble, it's also a real estate bubble. So in terms of market cap, we're probably going up a level here.
And this one, I think, definitely ticks all of the boxes. So what caused it? Partly, I think, was, again, a narrative. One that the Japanese government and also the central bank would have to stimulate the economy massively. And monetary easing at the time was pretty exceptional. So the Bank of Japan slashed rates in the mid-1980s. They lowered it to 2.5%, which in those days was very low.
Yeah, it was in response to a shallow recession. So they had, a logic for doing it. But stock prices continued to go up and real estate prices continued to go up, even when there was a little bit of recession. And they kept monetary policy very easy.
There was deregulation, financial deregulation. Often you get a bubble forming after a period of deregulation because people just take too much risk. If you let people play, they'll play. And there'll be financial engineering.
Can I give you some stats about this bubble?
Oh, I love this bubble.
And I'm going to split it into two sections. So the real estate bubble and the stock market bubble, even though they're intertwined. So let's go with real estate first. From 1956 to 1986, that's 30 years, land prices in Japan increased 50-fold, even though consumer prices only doubled over that period. So you're looking at real estate growing way, way faster than inflation. And what that resulted in was a market that was just extremely richly valued. So by 1990, which was the peak of the bubble, the Japanese real estate market was worth 4 times the value of the real estate across the whole of the United States. And that's despite Japan being 25 times smaller than the US and having 200 million fewer people.
And my favourite stat is about the land under the Emperor's Palace, which if you've ever been to Tokyo is absolutely tiny. It's 3/4 of a square mile. Beautiful gardens, beautiful palace. And that was estimated to be worth about the same as all the land in California or all the land in Canada.
Interesting. Would you rather own all of California, all of Canada, or this little palace in Tokyo?
Canada's nice. I like Canada.
But you're going to go for Canada. I think I'll take California.
Earthquakes, mate.
But I'm not going for the Imperial Palace in Tokyo. And weirdly, if you look at Tokyo, the real estate there, that one city, it's a big city, but it's just one city, was valued equally to the entire continental United States. So real estate there in Japan ran up to crazy levels. Like those stats, and you look at them and you say, how did that happen? Was the stock market any more sane? Not really. So if you wind the clock back to 1980, before the big run-up, the Japanese stock market made up around 15% of global market cap. By the end of that decade, it made up more than 42% of global equity markets. So that's a big jump in 10 years.
And it's probably worth saying that currently it's around 12% of global markets by market cap.
Yeah, I think it became the biggest equity market in the world for a very brief period, bigger than the US.
Yes, it did. And it's kind of shocking because the US shrank during that period. If you look at a graph of US market cap relative to the rest of the world.
Yeah, when you think of it today, when the US is more than 60% of global markets, it seems kind of extraordinary. And if you look at Japan's stock market at the time compared to GDP, the scale of the bubble just becomes blatantly obvious. So in 1980, stocks in Japan were worth around 29% of GDP, kind of normal. And they rose by the peak to more than 150% of GDP. And you can just see it in the returns, right? So if we look at the 30 years to the peak of the bubble, Japanese large caps were gaining on average 22% per year.
Yeah.
You know, for 30 years, small caps were up 30% per year. This is what we mean when we say markets can stay irrational longer than you can stay solvent, right? This bubble just kept on going and going.
And my favourite measure of expensiveness, which is the price to earnings ratio, in 1989 in Japan, it was a 60 times trailing 12-month price to earnings ratio, which is unbelievably large. And if you look at the CAPE ratio, which is a cyclically adjusted price to earnings ratio, this is Robert Shiller's measure, that reached nearly 100 times. And that's double what the US was trading at in terms of valuation at the height of the dot-com bubble.
Yeah. Whatever stat you look at, you go, boy, this was a big bubble. I mean, how did it pop?
So in 1989, policymakers decided to do something about this. But at that point, the bubble was just too large. And then in the early 1990s, that's when it really started to bite. And economic growth slumped. And that led to the lost decade period for Japan.
And if you talk about the duration of the crash, this might be the worst one, right? If you look at the stock market index for Japan, and here I'm thinking of the topics, which is kind of like the S&P 500, but for Japan, that only recovered to the level it reached in 1989 this year. What's that, 34 years later?
So deep and long. That's how you describe this one.
And that's in nominal terms. So we're not back there in real terms yet.
But again, they've been flirting with deflation for a while. So for them, it wouldn't be such a big deal.
But to me, this bubble has pretty much it all. It was long lasting. It was across massive markets, stocks and real estate. It was a deep crash. It was a very, very, very long crash. And it had wide ranging economic fallouts. Like Japan went from the technological leader in the 1980s to an also ran, and growth has been anemic.
So I'd say this would definitely scale as 9 on this 10-point scale.
Yeah, I'll go with that. I would have given it a 10, but for the fact it's finally got back to its pre-bubble level now. So it has recovered at least.
You weren't alive for that one, were you, Michael?
Yeah, I was born in the mid-80s.
Okay.
I didn't have any stocks when I was a 5-year-old, so I was unaffected largely.
Yeah, you were a toddler, okay. Whereas the next one that we're going to do, which is the dot-com bubble, you were almost into your teens?
Yeah, I would have been in my teens. So it burst in 2000, right? So I would have been like 14, 15, using many of the nascent internet products, dare I say it. So the dot-com bubble, it's got bubble in the name. Was it a big one?
It was definitely a big one, and it was centered on the United States, certainly, but it did affect global markets. And it was very volatile, so big run-up, a huge crash that followed.
The context for this being excitement about a new technology again. And we do see that theme coming up again and again. We said it in the Roaring Twenties in America when people loved fridges and what have you. And we said it in Japan, right? They were the leader of technology. And now this was a new technology, the internet.
And what's interesting about this is that a lot of the ideas, a lot of the hype at the time did come to fruition. We all do rely completely on the internet, but it took a lot longer to work out how to make money from it than people realized it would take at the time.
This is why I'm not going to score this as high as the Japanese bubble, is because it was a bubble, but it was just early. It wasn't wrong.
Yeah. And a lot of the companies that were no-hopers were swept away in the popping of the bubble. But many of them which survived are now today's tech giants, companies like Microsoft, for example, and Apple.
Yeah, and Amazon. Like, these companies did suffer in the bubble. Amazon was down, I think, 90% peak to trough during the dot-com bubble before it went on to be, one of the biggest companies in the world. So bubbles aren't necessarily a death knell for companies.
Yeah, maybe they're just ideas before their time. But if you look at the NASDAQ Composite Index, that rose from about 750 at the beginning of 1990, and it reached over 5,000 in March of 2000.
Yeah, in 1990, the value of stocks traded on the NASDAQ was worth 11% of the value of the stocks on the New York Stock Exchange. By the end of the decade, the value of the NASDAQ made up 80% of the stocks traded on the New York Stock Exchange. Tech came to dominate the market.
And that's a pattern that we haven't seen fall back, really. It fell back after the bubble imploded slightly. But we're back to euphoria now, I'd say, with the AI narrative.
What was interesting about the dot-com bubble was that there was this run-up across the course of a decade. And then there was what some people refer to as the blow-off top, which you see in a lot of bubbles, where it just, towards the end, where you think, hey, this can't go any higher, it suddenly surged massively.
Yeah.
So in 1999, the year before the big popping, the NASDAQ rose 85% and the S&P 500 rose 20%.
So just think of the FOMO. If you hadn't been part of that bubble, you'd be really tempted in the final stages to get sucked in. And that's the most dangerous thing, right? If you buy right at the top, that's when you really get hurt.
Maybe one of the telltale signs that all was not well was the change in concentration. So in that last year of the run-up, 1999, 85% gain in the NASDAQ, more stocks in the index actually fell in value rather than rose. So it was getting more and more concentrated in a handful of companies.
Interestingly, as it is today.
Yeah, although valuations are not where they were in the dot-com bubble.
No, they're not.
Even if they're stretched.
And as part of that narrative, I just love some of these stories about the reports that were written at the time by analysts. There was a Wall Street Journal article suggesting that investors rethink the quaint idea of profits. Who cares?
Yeah.
It's all about burn rate. And it was kind of cool at the time. The bigger the burn rate, if you were going through your cash really quickly and making a loss, that was seen as a good thing.
Yeah, so many of these companies were unprofitable. They were IPOing and then going bankrupt sort of 9 to 10 months later, like pets.com. where they had no real business plan other than we have the domain name pets.com, we're going to sell pet food. But then I always compare it to Amazon. Like Amazon was the one selling books and that became the biggest company in the world. I think it would be hard to go, the pet store's going to go bankrupt, the book company is going to go to the moon, right? You don't know at the time.
Yeah, at the time, you couldn't tell.
And like you say, it was all about burn rate, wasn't it? How much money can we raise from investors and keep ourselves going until we can reach profitability at some point in the future? But they were burning money on crazy things. So, you know, the Super Bowl ads is always the one people come back to. And this is a kind of bellwether of profligate spending, I guess. They cost $2 million at the time for a 30-second commercial. And 17 .com companies bought ads in the Super Bowl that year, which we saw repeated actually in the crypto bubbles, haven't we? With the crypto platforms buying ads during the Super Bowl.
Maybe that's the contrarian indicator.
I think it is one of them, yeah. Although crypto's recovered.
Now, the losses at the time, because obviously inflation pushes up prices over time, it gets bigger and bigger over time. But in dollar terms, the losses were estimated at $5 trillion, which, of course, in today's money would be much higher.
And those losses reflect the fact it was a huge peak to trough fall. So from March 2000 to October 2002, the NASDAQ fell from over 5,000 to barely 1,000. And it raised pretty much all of the gains it built up during the dot-com bubble.
But looking back on this one, you just see the valuations after it imploded, and you just think that's an amazing opportunity. So this is why I think people should really look at valuations. And the best indicator that valuations are important is when people say they're not important. That, for me, is always the red flag.
When you've got a load of profitless companies raising huge amounts of capital.
Profitless companies, lots of credit available, people saying that valuation doesn't matter. All of that stuff to me are the warning signs.
What about insiders cashing out? Because I read that not everyone lost money during the dot-com crisis. Over the last year of the bubble, between the summer of 99 and the summer of 2000, insiders at dot-com companies cashed out around $43 billion by selling stock, which was twice the rate of the year before. And insiders were selling 23 times as many shares as they bought. So, you know, people inside the companies did pretty well.
It was interesting for crypto. The thing that kind of warned me, and I perhaps shouldn't mention this, but there was a guy who'd started up a crypto company, a technology company. And I said to him, how much crypto do you own? And he said, nothing, absolutely nothing. And he was telling me how he thinks the prices were manipulated. And so, you know, that certainly was an interesting thing for me. So I think you're right. I think that insiders are a good way to gauge whether there's a bubble. But unfortunately, we don't know what the insiders are doing often until it's too late.
And it's really hard in real time to diagnose a bubble. I'd say in Japan, in that one, it should have been a bit obvious, right? The scale of the valuations relative to international comparisons was crazy. But like you say, with crypto and Bitcoin now, some people say this is a bubble, this is worthless or whatever, and it's valued at huge amounts of money, whereas others would say, no, it's the future. So how can you tell? Like, there's no objective measure of value really for Bitcoin. It's what people were willing to pay for it.
Yeah, if it's something where there isn't a profit which it generates, then you can't compare the price with the profits, and you can't really say whether it's in a bubble. Whereas for something like stocks, it's got this built-in bubble indicator, which you can look at and ignore. But certainly at the moment, it's looking like the US is expensive again. Not crazily expensive, not kind of crazy bubble expensive, but expensive.
So let's go back to the dot-com bubble, because we haven't given that a score yet. What do you reckon?
Well, the thing is, this one was followed by another one, the global financial crisis. And so it was kind of eclipsed. People have forgotten it in a way. And like you say, we've almost got the bubble reinflating today. So it doesn't feel like such a bubble. But, you know, I'd say this one was pretty scary at the time. And I remember the aftermath in 2003 when people just thought markets would never recover. So for this one, I'd say probably a 7 for me. I lived through it.
Yeah. I'm going to go 6, I reckon, because it has recovered and it has proved to be the future, even if a load of capital was wasted along the way. But it brings us, though, to the question at hand, which is what is the greatest bubble in history? And from the scores we've given, I think it's Japan, right? We gave that a 9.
Yeah, I think Japan is definitely the one, which I think had the biggest impact. maybe the Great Depression because it was global, whereas Japan was just a single country.
But I think Japan's the only one that hasn't recovered. Like in real terms, it is still below where it was then.
And if you look at the valuations, it was just off the scale. It makes all other bubbles look fairly paltry in comparison. So yeah, I'd say Japan is the one. Now, people are always worried about investing, whereas you'll notice that the bubbles were actually spaced decades apart. So if you are concerned about a bubble right now in investing, then why not join our community and perhaps put your mind at rest, or at least be aware of the risks. If you want to learn more about that, just go to our website, PensionCraft.com.
Okay, today's dumb question of the week is, are markets rational? Now, I think it's fair to say that most economic theories and theories around markets rely on rationality and people acting in their economic self-interest and making rational decisions. But is it true? Is that how it works?
Well, in a previous life, I used to work in experimental psychology at Oxford, and I worked with some super bright people. And one of the papers we published was about bounded rationality. The idea being that, yeah, humans are rational, but we don't have infinite cognitive capacity. So we do the best we can in the time we have available and with the attention we've got available. So as a father with a young child, I'm sure you know that your rationality is a little bit stretched if you're looking after a toddler.
I'll just say that the other day I had to make an ice cream bagel for her because she saw an ice cream sandwich in a magazine. So rationality's gone out the window in this household.
So ice cream bagels or buying markets when they go up to crazy valuations is all part of the same continuum. So I think humans are rational, but human nature forces us sometimes to do things which are not rational. And if you ask people why they buy stocks during one of these bubble episodes, they'll just tell you, well, prices are going up. So you can see these positive feedback loops. Prices go up, it's written about by journalists, people pile in, and the bubble continues until it reaches some crazy level or there's a triggering mechanism, something bad happens, and the thing implodes. And I think George Soros's ideas about reflexivity are a really useful way to understand this.
Oh, interesting. I'm not really aware of the detail of those. What does he mean by reflexivity?
Well, the idea is that market participants do not base their decisions on objective reality. Instead, it's based on interpretations of reality, which I think is probably true. But then what's interesting is that those interpretations, in turn, influence economic fundamentals. And that creates this feedback loop. You can see it in inflation as well. People talk about anchoring inflation expectations, where if you think prices will carry on going up, well, you'll demand higher wages. And so that in turn actually creates reality from your perception. So I think this also works in markets where people see prices going up. They think it'll continue, they carry on buying, and it creates this positive feedback.
Yeah, that's really interesting. And I think there's definitely an element of that in markets. Like sometimes when there's an arms race in a new industry, it is a game of who can raise capital the fastest to win the market share. And even though there's lots of profitless companies, one company might just tell a good story, raise lots of money, and come to dominate social media or whatever it is. Their platform wasn't better than the others, maybe, but it did come to win. So yeah, perception becomes reality.
And if you've got blitz scaling and the ability to draw on huge amounts of venture capital, then really it's about how good your narrative is. If your slide deck's better than somebody else's, you're going to create this new reality of a successful company.
The thing with Elon Musk is that, yes, he's kind of a visionary, right? He's started so many things which have changed the world. He's getting rockets to go to planets and land back on Earth, blah, blah, blah. But his main skill to me is his ability to raise capital from investors to make these things a reality. Being a visionary means nothing if you can't convince investors of your vision.
Yeah, you can almost see him as a catalyst in creating these feedback loops. He stands as the arbiter between the narrative and reality, and he turns the narrative into reality.
If he tweets about Dogecoin, people like to buy digital currency with dogs on it.
Although that didn't turn out so well, of course. But I think this is interesting that, in a way, buying into a bubble is rational. And this is one of the things that Soros says. As soon as he sees a bubble, he buys it because it's just a matter of getting out at the right time.
Yeah, but how do you do that? I mean, all of this discussion kind of flies in the face, really, of efficient markets theory, right? Which is that everything's priced in and that markets are acting, in general, rationally.
I think long term that's true. And that's why things like valuations are mean reverting eventually. But you get these very long periods where you have deviations above and below the average valuation. After the dot-com bubble imploded, valuations were depressed for a long period of time. And after this period of zero interest rates, we've still seen valuations remain elevated, even after the Fed raised interest rates. So these can be very long lasting.
And certainly on a kind of anecdotal basis, you get examples of things where efficient markets hypothesis is just false, right? I remember in the meme stock rally, GameStop was, at the heart of it. And that had the ticker GME. And I think there was an entirely unrelated company in one of the Asian markets, maybe it was Japan, also with the ticker GME. And its stock price went crazy, like jumped 100%, despite being nothing to do with it, just because it had the ticker GME. Like, that is in no way rational. Do you know what I mean?
Yeah, but that's a good example of bounded rationality. People didn't look up the ticker accurately enough, and so they ended up buying the wrong stock.
Obviously, they'd have been much better served buying the real GameStop.
For a while.
I mean, to answer the question, are markets rational? I think you're right. It's like, yes, kind of in the long term up to a point, but there's limited information. So even if they were perfectly rational, they're not always going to price things correctly, or at least not compared to if you were omniscient. And the other thing I think about markets is that quite a lot of the actors in there making decisions about buying and selling are not acting in a kind of rational self-interest. If you're a manager of a fund, you're not always just trying to get the best return. Sometimes there's peer pressure and career risk, which means you do things which are against your better judgment because you don't want to deviate from the herd too much. And there are other examples of incentives that are not just about pure rationality, like in the global financial crisis with the real estate bubble in the United States and the subprime mortgage crisis. As that got bigger and bigger, more people started selling subprime loans, which meant you had to bring in more staff who were maybe less qualified. Their incentive is not to make rational decisions about underwriting loans. It's to get loans out of the door as quick as possible.
Yeah, it became a paper moving business. The more paper you could move, the more profit you could make.
So do you see what I mean about incentives are not rational for everyone? They are for us, right? Me and you managing our personal finances. We are balancing risk and reward. We're trying to make rational decisions to grow our wealth and meet our goals. But, there's loads of people managing money where that isn't the goal.
And you can also get a situation in which each person acts rationally, but the overall result isn't rational. So, often these bubbles are formed by people buying into a narrative which makes sense for them. But in aggregate, what happens is the market effectively becomes unsustainably large.
And the thing about bubbles is that they pop. If they don't pop, then it's not a bubble, even if it's crazy.
But I think the real danger about bubbles is that it stops people from investing. People say, look, if you look at valuations, they're too high. I'm not going to pull back money from the market. I put it all into money markets. And I just think, oh, no, that's probably a bad thing to do.
It's the wrong lesson to learn, isn't it?
Yeah, and I think if we should warn people, if they're listening to this episode, don't worry about bubbles because long term, everything will be fine.
So long as you're diversified. To me, that's the lesson to take away from like Japan, which we said was maybe the worst bubble, is that if everything was in Japan right at the peak, you wouldn't have been happy over the last 3.5 decades. But if you were diversified across global markets, you'd have done really well. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.